Hello everyone. Our topic for today is understanding of saving and investment. We Indians have a strong saving habit because our parents have inculcated the habit of saving money right from our childhood. As a child, we were asked to save from our pocket money, and when we started earning, we were asked to save from our salary or business income. So, saving comes naturally to us. But the problems start when it comes to investments. India is a home to 17.5% of the world's population, out of which only 24% of its population is financially literate. We can also say that 76% of its population know nothing or know less about saving and investment. Therefore, let us start from the basics of what is saving and what is investment. Let us start from what is savings. Savings is a surplus of money left from income after expenses. Or in simple words we can say, it is an excess of money after expenses. For example, if the income is 30,000 rupees, household expenses are 20,000 rupees, personal expenses are 5,000 rupees, then the amount which remain after these expenses, that is 5,000 rupees, is the saving. So, do you think saving is important? The answer is yes. People save money because the future is uncertain. Saving is important to finance your unplanned expenses. Investors also save money for their future financial goals. Financial goals can be child's education, retirement, buying a house, buying a car. It can be anything. Generally, people save their money in saving accounts or keep their money in cash for their unplanned expenses and for their financial goals. But do you think saving is sufficient? The answer is no. Let us see why. Saving is not sufficient because inflation eats away your money. We have all seen that prices of goods and services increase over the period of time. The annual rate at which the prices of goods and services increase is called inflation. Say a movie ticket would have cost you rupees 50 in the year 2000, but in the year 2017, a movie ticket cost you around rupees 200. Similarly, prices of our day-to-day goods like milk, fruits, clothes, etc. increase because of inflation. So, due to inflation, to buy the same quantity of goods every year, you have to spend more and more money every year. Therefore, just by saving money, you will not be able to cover the cost of inflation and plan for your future goals. Generally, investors get around 3 to 4% in saving account and the average inflation is around 6 to 8%. Therefore, it is important to channelize this saving into investment. So to summarize, saving is important for contingency expenses. Those expenses which are unplanned expenses like medical expenses. Saving is for short-term goals, while investment is for long-term goals. Now, let us look at different investment options available for investors. Investors can invest their money either in physical assets or financial assets. Let us first go through the list of financial assets available to investors. Investors can either invest in fixed income securities or securities which are linked to the market. The interest earned on fixed income securities ranges from 6 to 8% and generally the interest is taxable. Only in case of PPF the interest is tax free. The liquidity ranges from very low to medium because a bank may penalize you for premature withdrawal. The tenure of fixed income securities varies from products to products. In case of debt mutual fund, the return ranges from 7 to 10% because the returns depend upon the securities in which the debt mutual fund invests. Investors also get the benefit of indexation after 3 years. The liquidity is very high because investors get their money in T plus 2 days, that is transaction plus 2 days. Some debt schemes offer redemption on the same day of transaction. Tenure in mutual fund debt scheme ranges from 1 day to 5 years. Investors who want to park their money for 1 day can also invest in debt mutual fund. In case of equity mutual fund and direct equity, investors can expect a return of 15% in long run. The long-term capital gain tax in equity after 1 year is 10%. The liquidity is also very high. Investors can redeem their money in T plus 2 days. Investment in equity mutual fund or direct equity should be ideally for more than 5 years. Investors also have an option to invest in physical assets such as gold and real estate. Returns in gold are linked to inflation. That is the reason why gold is said to be best hedge against inflation. The liquidity of the gold is not as high as other financial assets. In case of real estate, investors can get the benefit of indexation and the liquidity of real estate is low compared to other products. Apart from these factors, investors also have to look at the impact of taxation and inflation on their investment. So let us learn how to calculate real rate of return.